Today we're doing a full Today we're doing a full deep dive on all the biggest financial moves from around the globe this week. Credit risk, AI sparks, earnings surprises, trade wars, central banks, and more. Let's start with one of the biggest undercurrents. Credit risk is alive and well. US bank stocks took hits after distress signals from a couple of regional banks and fallout from auto sector bankruptcies. Gold exploded higher, best week in 17 years. That's a classic sign. When debt and credit fears rise, precious metals get love. The US dollar is weakening under expectations the Fed might ease, but some analysts warn don't count on big moves yet. This sets the backdrop. Growth is fragile, leverage is exposed, and markets are walking a tightrope between risk and hope. Markets got a jolt from AI optimism, strong earnings from US banks, improving business sentiment, and chip demand all boosted stocks. TSMC is forecasting up to 24% revenue growth in Q4 on AI device demand. That's massive. Meanwhile, Europe is seeing signs of life. Despite tariff tensions, corporate earnings are expected to grow about 0.5% year over year. Not great, but better than a decline. Still, it's weak historically. Tariffs and uncertainty are keeping profits in check. Switching to Washington, the specter of a government shutdown looms large. It's making traders jittery. We could see delays in key data, disrupted services, and increased risk premium. If Congress can't pass a continuing resolution, it postpones jobs data and complicates the Fed's decisions. Markets hate data vacuums, so expect volatility if things get ugly in DC. Over in Europe, shares are soft, energy and healthcare dragging the STO XX 600. Forecasts improved from a small decline to about 0.5% growth. ECB watchers ask, after aggressive cuts, will they pause? The euro's cooling gives them cover to hold steady. But new US tariffs on Chinese goods and export controls are rattling Europe, and the EU's trying to reduce reliance on the US by cutting new deals with India, Malaysia, South Africa, and the UAE. Prada got EU approval to acquire Versace, another big luxury merger. Macquarie is buying 12,000 student beds across Europe, proof capitals still chasing yield. Europe's chemical industry, meanwhile, is under stress: plant closures, high costs, and overcapacity. Trade war news. The US just announced 100% tariffs on Chinese imports and new software export limits starting November 1st. Back in July, Trump threatened 30% tariffs on EU and Mexico goods, spooking markets. Eventually, the US and EU reached a 15% tariff truce. Markets cheered, but the devil's in the details. Forced military purchases and unresolved issues remain. The EU's diversifying, fast-chasing new trade deals with India and others. And ECB President Lagarde reminded everyone any resolution will require real compromise. Global investors are eyeing Europe as more stable than the US right now. The euro's strength is double-edged, good for inflows, bad for exports. Oil and commodities are swinging wildly, supply gluts battling geopolitical risk. And with central banks turning dovish, bond yields are slipping while credit spreads widen. Watch that curve. One theme: credit overhang. Debts still stressing institutions even as markets chase growth. Second, AI is the new growth engine, but it's front-loading demand and volatility. Third, trade and geopolitics aren't background noise anymore. They are the market. Fourth, central banks are tightrope walkers now. Fifth, capital keeps chasing yield. Real estate, infrastructure, emerging markets, alternatives. Just look at Macquarie's move, fraud at Jefferies, Holdco versus Eastern. All these fit the bigger picture. Riskier credit makes activism harder. Tariffs squeeze margins. If the Fed holds, leveraged plays feel it first. You're not just hearing headlines, you're seeing how everything connects. Upcoming catalysts, jobs and inflation data if weak, rate cuts speed up. Whether Congress avoids a shutdown. Q4 guidance from banks and AI firms. ECB meetings more cuts or pause. Trade talks US-China, US-EU, EU-India. And credit defaults regional banks, auto loans, leveraged corporates. Any one of these could swing markets fast. Stay tuned for more weekly recaps like this, and don't forget to follow and subscribe Bulls Market.